The Strait of Hormuz is only 21 miles wide at its narrowest point, yet for decades it has carried the weight of the modern global economy, like a steel artery carrying blood to every major organ. Nearly one-third of the world's seaborne oil exports and roughly one-fifth of total global petroleum consumption pass through this narrow corridor between Iran and Oman, making it one of the most strategically important waterways on Earth. Every day, massive oil tankers leave the Persian Gulf loaded with crude from Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, and Qatar, then squeeze through a shipping lane so narrow that vessels moving in opposite directions are separated by only 2-mile-wide channels. If that passage is disrupted, even briefly, the effects ripple outward across fuel prices, stock markets, shipping insurance, inflation, and geopolitical stability with astonishing speed. The danger of Hormuz has always been rooted in geography, because geography creates leverage that technology cannot fully eliminate. Unlike stock markets or digital networks, oil still has to move physically across oceans, and the Strait of Hormuz became the world's most dangerous economic choke point because there are very few practical alternatives large enough to replace it. For decades, military planners, economists, and energy executives have quietly understood the same uncomfortable reality that most consumers never think about while filling their gas tanks. A single regional confrontation inside the Persian Gulf could trigger economic consequences felt in New York, London, Tokyo, Mumbai, and Beijing within days. That fear reached dangerous levels multiple times throughout modern history, but one period in particular revealed how close the global economy came to genuine shock. During the late 1980s, and again during the escalating confrontations of the 21st century, Hormuz transformed from a trade route into a geopolitical pressure valve capable of shaking financial markets across the world. The story of Hormuz is not simply about oil, because oil itself represents something larger than fuel. Modern civilization depends on uninterrupted energy flows, the same way ancient empires depended on rivers. And when those flows are threatened, the stability of entire economies begins to wobble beneath the surface. The strategic importance of the strait emerged after World War II as the Persian Gulf became the center of global petroleum production. By the 1970s, the Gulf states controlled some of the largest proven oil reserves on Earth, and industrial economies in North America, Europe, and Asia became deeply dependent on uninterrupted Gulf exports. The oil shocks of 1973 and 1979 revealed how vulnerable the global economy had become to Middle Eastern instability. After the Arab oil embargo and the Iranian Revolution, energy prices exploded, inflation surged across Western economies, and policymakers suddenly understood that control over maritime oil routes had become a matter of national security. The United States responded by expanding its naval presence in the Persian Gulf through what became the U.S. Fifth Fleet structure and broader Central Command operations. Washington's strategy centered on one principle that would dominate regional policy for decades. The free flow of oil through Hormuz had to be protected at almost any cost. Iran viewed the same geography from an entirely different perspective because the strait also represented leverage against larger powers. Since nearly all Gulf oil exports passed directly beside Iranian territory, Tehran understood it possessed the ability to threaten the global economy, even without matching the military strength of the United States. That imbalance created a dangerous form of strategic asymmetry. The United States controlled overwhelming conventional military power, while Iran controlled proximity to the world's most critical energy bottleneck, allowing smaller actions to create outsized global consequences. The first major demonstration of this danger emerged during the Iran-Iraq War, which lasted from 1980 to 1988 and killed hundreds of thousands of people. As the conflict intensified, both sides began targeting oil tankers and commercial shipping in what became known as the Tanker War. Iraq initially attacked Iranian oil exports to weaken Tehran's economy, but Iran retaliated by threatening Gulf shipping routes more broadly. By the mid-1980s, commercial vessels traveling through Hormuz faced missile strikes, naval mines, and aerial attacks that turned the Persian Gulf into one of the world's most dangerous commercial waterways. Between 1984 and 1988, more than 400 commercial ships were attacked in the Gulf region. Oil tankers burned at sea, insurance costs surged dramatically, and energy traders began pricing geopolitical fear directly into global crude markets. The crisis escalated in 1987 when Kuwait requested American protection for its oil tankers after repeated attacks threatened exports. The United States launched Operation Earnest Will, one of the largest naval convoy operations since World War II, reflagging Kuwaiti tankers under the American flag and escorting them through the Gulf. That operation revealed how quickly regional instability could drag global superpowers toward direct confrontation. US. Warships suddenly found themselves operating inside an active combat zone, where a single mistake carried the potential for catastrophic escalation. Those fears nearly became reality in April 1988 after the USS Samuel B. Roberts struck an Iranian naval mine in the Gulf. The explosion tore a massive hole in the frigate and almost sank the vessel, triggering one of the largest American naval battles since World War II. The US. Military responded with Operation Praying Mantis, destroying Iranian naval assets and oil platforms in a fierce one-day confrontation. Iran suffered severe losses, but the deeper message was unmistakable because the world had just witnessed how quickly Hormuz could pull global powers into open conflict. Markets reacted nervously throughout the crisis because oil traders understood the mathematics of disruption. Even temporary interruptions inside Hormuz threatened millions of barrels per day in exports, and global supply systems had very little spare flexibility during periods of rising demand. The danger never truly disappeared after the Iran-Iraq war ended because the underlying structural problem remained unchanged. Too much of the world's energy supply still depended on one narrow waterway surrounded by geopolitical rivals armed with missiles, mines, patrol boats, and increasingly advanced military technology. By the early 2000s, the Strait of Hormuz had become even more economically critical due to rising energy consumption in Asia. China's industrial expansion dramatically increased global oil demand, while Japan, South Korea, India, and other Asian economies became deeply reliant on Gulf crude imports passing through the strait. At the same time, tensions surrounding Iran's nuclear program intensified steadily. Western sanctions targeted Iranian banking, shipping, and oil exports, while Iranian leaders repeatedly warned that escalating pressure could lead Tehran to restrict traffic through Hormuz. Those threats were never viewed as empty rhetoric inside global financial markets. Analysts at the US Energy Information Administration estimated that roughly 17 million barrels of oil per day passed through Hormuz in 2011, representing nearly 20% of globally traded petroleum liquids at the time. Oil markets operate partly on physical supply and partly on expectations of future disruption. That means prices can spike long before a shipping lane is actually closed, because traders begin anticipating shortages, governments increase emergency purchases, and insurance companies raise risk premiums across maritime commerce. This dynamic became visible repeatedly during the 2010s as Iranian officials threatened closure of the strait during periods of sanctions pressure. Even without actual disruption, crude oil prices frequently surged on fears that escalating tensions could spiral into military confrontation. The situation became especially volatile in 2019 after the United States withdrew from the Joint Comprehensive Plan of Action, commonly known as the Iran nuclear deal. Washington reinstated severe sanctions targeting Iranian oil exports, while attacks on tankers near Hormuz reignited fears of regional escalation. In May and June of 2019, several commercial vessels suffered explosions near the Gulf of Oman close to the entrance of the strait. The United States blamed Iran for the incidents, while Tehran denied involvement. But the immediate economic effect was clear because global oil prices jumped sharply amid fierce supply disruption. Only weeks later, Iran shot down an American surveillance drone near the Strait of Hormuz, bringing the two countries dangerously close to direct military conflict. President Donald Trump later stated that planned retaliatory strikes were halted only minutes before execution, illustrating how rapidly events inside Hormuz could approach full-scale war. Financial markets responded with the same pattern seen throughout previous crises. Oil prices climbed, shipping insurance premiums increased dramatically, and governments across Asia and Europe began reassessing their vulnerability to energy disruptions originating in the Persian Gulf. The reason Hormuz matters so deeply is not simply because oil passes through it, but because modern economies are synchronized around uninterrupted energy availability. Transportation systems, manufacturing supply chains, aviation networks, agriculture, plastics production, and electricity generation all remain tied in some way to stable hydrocarbon flows. When energy prices spike suddenly, inflation spreads outward like pressure cracking through glass. Fuel becomes more expensive, shipping costs rise, consumer goods increase in price, central banks face inflationary pressure, and financial markets begin adjusting to slower economic growth expectations. This chain reaction explains why Hormuz crises often influence economies far removed from the Middle East. A tanker confrontation near Iran can eventually affect mortgage rates in the United States, factory production in Germany, food prices in Africa, and stock market valuations in East Asia. Governments have spent decades attempting to reduce this vulnerability through diversification strategies. Saudi Arabia and the United Arab Emirates built pipelines designed to bypass Hormuz partially, while countries expanded strategic petroleum reserves intended to cushion temporary disruptions. The United States also transformed global energy markets through the shale revolution, beginning in the late 2000s. American crude production surged from roughly 5 million barrels per day in 2008 to over 12 million barrels per day by 2019, reducing U.S. dependence on Gulf imports significantly. Yet the global system remains interconnected despite those changes. Even if America imports less Gulf oil directly, disruptions inside Hormuz still influence global benchmark crude prices, and those prices affect every economy connected to international energy markets. China now faces particularly high exposure because it imports enormous quantities of Gulf oil through the strait. Beijing has therefore expanded naval operations, invested heavily in strategic reserves, and pursued infrastructure projects across Eurasia, partly to reduce long-term maritime vulnerabilities. This broader competition reveals that Hormuz is no longer just a regional issue between Iran and the United States. It has evolved into a central pressure point inside the larger global contest over energy security, trade routes, military influence, and economic resilience. Military technology has also changed the nature of the threat dramatically over the past 2 decades. Iran invested heavily in anti-ship missiles, fast attack craft, naval mines, drones, and asymmetric warfare strategies designed specifically to exploit the narrow geography of Hormuz. Military analysts often compare the strait to a pressure valve because relatively inexpensive weapons can threaten extremely valuable commercial traffic inside confined waters. Even temporary uncertainty can disrupt shipping schedules and trigger panic across commodity markets. At the same time, the United States and its allies maintain overwhelming naval firepower in the region. Aircraft carriers, submarines, destroyers, surveillance systems, and missile defense networks operate continuously around the Gulf to deter attempts at closure. That balance creates a dangerous paradox where neither side fully controls escalation. Iran likely cannot sustain a permanent closure of Hormuz against combined Western military power, but it may not need to because even limited disruption could create severe short-term economic damage worldwide. This reality explains why global markets react so strongly to incidents that may appear minor in isolation. A single mine attack, drone strike, or tanker seizure inside Hormuz carries symbolic weight far beyond the immediate event because traders understand how fragile the system can become under pressure. The deeper lesson of Hormuz is that globalization created extraordinary efficiency while simultaneously concentrating risk into critical choke points. Just as supply chains became vulnerable during the COVID-19 pandemic, energy networks remain vulnerable to disruption at a handful of geographic bottlenecks. Hormuz represents the largest of those bottlenecks because so much of the modern industrial world still depends on petroleum moving through a narrow corridor surrounded by geopolitical tension. The system functions smoothly until confidence begins breaking down, and then even small disruptions can trigger outsized economic consequences. Ironically, the world may gradually reduce its dependence on Hormuz over the coming decades through renewable energy expansion, electrification, and diversified supply networks. Yet the transition itself may create new geopolitical tensions because nations still compete aggressively over energy security during periods of structural change. That means Hormuz remains dangerous, not because collapse is inevitable, but because the global economy still operates on assumptions of uninterrupted flow. Financial systems, trade structures, and political stability all depend on energy continuing to move invisibly through narrow channels most people never think about. The contrarian insight is that the greatest risk surrounding Hormuz may not be permanent closure at all. The real danger lies in repeated cycles of uncertainty, limited confrontation, and rising geopolitical mistrust that slowly increase costs, volatility, and fragility across the global economic system. History shows that markets can absorb individual shocks surprisingly well, but repeated pressure changes behavior over time. Governments spend more on defense, companies redesign supply chains, energy prices remain structurally elevated, and the hidden cost of instability quietly spreads throughout the world economy. The Strait of Hormuz, therefore, represents more than a shipping lane because it reveals how deeply interconnected modern civilization has become. A narrow stretch of water between Iran and Oman still possesses the power to influence inflation, growth, diplomacy, military strategy, and financial confidence across the planet. And that is what makes Hormuz so unsettling in the modern era. The global economy became larger, faster, and more technologically advanced than ever before, yet it still depends on a vulnerable maritime corridor where one regional crisis can send shockwaves through the entire world system.